Good afternoon all, and welcome to the October edition of the Bizwell webinar. I'm Graham Stephen, the co-founder and CEO of Bizwell. And today I'm joined by my fellow co-founders, Howard Blake, and my regular co-host, the Finance Ghost. In our previous webinars, we've extensively covered, what is known as sell-side factors. So as a seller, what makes your business more valuable? And we spend a lot of time on that. And I think today, both due to sort of requests from our customers and feedback received from previous webinars, we're going to look at it from the other side, and that is buying a business. We don't have any external guests today, but today's discussion is going to take the format of almost like a fireside chat, where we as the sort of founders of Bizwell, share our collective experience of what it takes to buy a business. So just some housekeeping. I think we've actually got a record number of registrations for today's session. So maybe that just tells us something about the interest in the topic. And we've got listeners and participants from 21 different countries. Before we get started, as our regulars will know, the chat section is set to private. So only the presenters and moderators can see your messages. Please feel free as we're going along to add questions as we're going along. Some of those we'll pick up in our conversation, but most of the questions we'll leave till the end and where we have a formal Q&A section. We will be recording the webinar and it will be made available on YouTube in case anything comes up or you need to drop off the call. Please also check out our handout section on Demio. You can find that clicking on the top right-hand section to download the latest newsletters, and I think the webinar slides are also available there. Once again, if you're curious to find out the value of your business or business that you're looking at, if you look at the sort of featured section of the webinar, we have our Bizwell Express free valuation tool. So please feel free to try that out. Give us your feedback, give us your comments. Okay, so let's move on to just some of the insights from our previous webinar. At our previous webinar, we asked the poll question is, do you have a succession plan in place? A lot of people didn't answer, but what was quite interesting there is that, most business owners don't have a formal succession plan in place. Some are thinking about it, and some have sort of a informal succession plan in place. And, with succession and independence being one of the key things of company value, this is really, really important. Not one of our participants had a formal documented succession plan in place. Today's poll question, and if you go to the poll, is very simple. Have you ever considered buying a business? And there's 4 options. Yes, I have, and I successfully completed an acquisition. Yes, but the deal never concluded. I've thought about it, but I've never proceeded. And no, it's never crossed my mind. And then lastly, if you've missed any of our previous webinars, these are available both on our website and our YouTube channel. Okay, so today we're going to be talking about how to buy a business. So as I said, it's going to take the form of a bit of a chat. We're going to share some of our stories. It's not going to be death by 1,000 PowerPoint slides, but we're broadly going to cover the sort of following 9 topics. Why do you want to buy a business? We're going to unpack a little bit sort of buying versus starting a business. How do you identify a business that you want to make an offer on? I'm going to talk about those sections. Then we're going to hand over to the ghost, who's going to go into sort of valuing a business that you want to acquire, structuring the offer and negotiating the deal, the due diligence and closing the deal. And then Howard's going to kind of lead the discussion around securing finance and the most important piece around sort of post-merger or post-acquisition integration and what happens in the sort of first 100 days after you acquire the business. So as I said, feel free to jump in as we go along. I'm going to switch off the slideshow so you can see our faces when we're chatting. So just give me 1 second to figure out how to do this. I think, there we go. So you can see our faces except for the ghost who likes to hide behind the mask. Okay, so let's kick off with the chat today. And I think the first question is, why do you want to buy a business? Before you go into acquiring a business, you have to ask yourself the question, is why do you want to buy a business? So to use an example, if you're buying a home, you would have that same question. Are you thinking of starting a family? You want a family home. Are you an entertainer? So do you want a lifestyle home that allows you to entertain? Do you want a holiday home? Do you want a fixer-upper? And I think with a business, it's very much the same. A lot of people harbor romantic notions of being a business owner. If you've watched The Bear or you've watched Succession, just having those romantic notions is not enough. You really need to think about, your motivations for wanting to buy a business. You look at the sort of popular notion of what a successful entrepreneur is, and you read in the news about billion-dollar exits and all of these sorts of things. The hard reality is it's usually not like that. 85% of businesses never end up selling. Okay, so your motivation needs to run deeper than that. I had a client, a month or two ago who came to us. He was actually he was an actuary. Young guy, late 20s, early 30s, and he wanted a new challenge. And he came to me to say, look, he wants to buy a pharmacy. And we started unpacking that and saying, well, like, what are your motivations? And when it came down to it, it was more a case of him wanting to leave corporate than him wanting to be an entrepreneur. So I think that's the first important thing: is if you want to buy a business, is it because you want to leave something and run, or is it because you want to run towards something? So that's an important consideration. I think a couple of other points to talk on is some of the reasons are forced. So sometimes people are made redundant, okay, and they can't find another job. So are you being forced to think about something else, buy a business, or is it voluntary? Is it a desire to build something grand, to leave a legacy? Is it because you want to live a particular lifestyle and you think by owning a business that it can do that? If you've never owned a business before, sometimes it's hard to think about that. So one of the things I always recommend to people is chat to other entrepreneurs, chat to other business owners, understand what the lifestyle of running a business looks like. Maybe, Howard or Ghost, and Howard, I'm going to ask you the question, you've been down this path a number of times. You've acquired businesses, you've been on the other side. What are some of the whys and some of the reasons that you see when people want to, get into buying a business?
Graham, I just think, in my own case, I started my business out of desperation. My first business, that was 35 years ago. I was in a law firm and ended up deciding not to take the partnership and basically being unemployed in the afternoon. And, that really gave me the motivation to get going. And I think in many ways, if I look back, sometimes the blissful ignorance around what you're getting involved with is the very thing that saves you. And if you believe that you can offer a product or a service, believe in that and pursue it with all the energy you've got. Don't worry about the competition and what other people are doing, because you'll build your own niche based on your personality and your energy. So, after that, obviously, the companies, the one that we formed in 1990 ended up becoming 7. There was a lot of M&A and activity around those. And, listening to your introduction, I think for the benefit of those people on the call that are thinking about buying a business or maybe getting involved, there's often more than just buying a business. Some people have a business. So if you've got let's just use a really simple example, the fish and chip shop. You might want to buy another 10 fish and chip shops, or you might just be happy with your fish and chip shop. So none of those are right or wrong. It's just about what you want to achieve personally. So often by acquisition, and an acquisition is sometimes more perilous than starting out your dream or your singularity, your idea that you're now going to take to the market. So it comes across in very many different forms, but I think, never be put off and don't doubt yourself. Often we get a great idea and we think, oh, it'll never work. Well, then it won't work. Yeah. If you believe in it and you've got that energy, carry that energy through and have a look at lots of different types of businesses and challenge yourself a little bit. Make yourself uncomfortable. It's not a bad thing. A lot of ingenuity and creativity comes around by being uncomfortable. and try and get exposed to as broad a spectrum as possible in terms of the opportunities that present themselves. And I'm sure later on we'll discuss about, how to do that and how to do it in a way that you don't blow your inheritance or your savings in the process, and we'll hopefully be able to guide you through that.
100%. I guess this is not a Simon Sinek webinar, but understanding that why and what your motivations is obviously the key first step. I think, Howard, you touched on, I guess, the next point, and that is around, buying a business versus starting a business. And again, I'm going to use the analogy of a home because it's something which is a little bit simpler and to understand is, if you want to move into a home, are you going to buy an existing home, an established house, or do you want to get a vacant piece of land and build a house from scratch? They both got their pros and cons. I think sometimes the idea of buying an established home might sound easier. You don't have to manage builders and, the plans and all of those sorts of things. But the reality is when you're buying an existing business or you're buying a home, it's also can come with sort of hidden structural defects. It can come with a lot of nuances and quirks, which you can't be naive about. So, the benefit of buying an existing business is usually that it's got existing clients, it's got processes, it's got a business model. So largely the heavy lifting's already been done, particularly if it's sort of an industry which is, established, whether it's a restaurant or a plumbing business or something along those lines. But when you're buying, you also have to deal with the existing owner, so if you're starting something from scratch, you define your course. When you're buying an existing business, the existing owner has got his own motivations for wanting to sell. He's got an expectation of valuation, so that might be realistic or not. He's got emotion tied into that. And, you're dealing with that. You're not just dealing with a clean slate. You're dealing with a lot of that sort of legacy as well. So, the decision to buy versus start goes deeper than just saying, well, I want to buy a business. If you're starting a business, as you say, it's maybe more difficult initially. Sometimes it's your only choice. If you don't have capital, you really have to bootstrap the thing and test the ideas from zero. With an existing business, it doesn't always come with that challenge. But it's also a bit like a corporate role. You've got existing staff, you've got existing problems. There might even be liabilities and, as I say, latent defects in the business that you don't know about. So, that buy versus build is an important decision. Buying a business is not always a shortcut to instant success. So, Howard, maybe you want to just jump in there.
I also think, especially since, we see the kind of data that we do on businesses that are for sale and people that are looking for businesses. I think we also need to, from an audience point of view, just to understand that not everyone selling a business is a charlatan or trying to pull a fast one.
100%.
There's lots of people who've traded their business very successfully through to retirement age, and they're getting to a point where the kids aren't interested and they're literally stuck with a business. They might not have the energy and they might not have succession, which we know is the biggest threat that we see off the data, where there's no succession in a business, its value is impaired. And that's why I said 85% might never sell. It's because no succession has been built in and you can't really hand it over.
Yeah.
So, it's so interesting what we see across the 6 continents of the valuations that are done with us and all the countries that do participate. We see global trends and we're able to share those global trends with this audience, which I think is a really unique opportunity for people who are thinking about business or wanting to get involved in business and listen to be able to be aware.
100%. And Howard, I think, just to talk about that, I mean, one of the trends that is emerging in terms of, selling and buying businesses is I think in the States, for example, and I'll just correct myself on the stat, but I think something like 60% of business owners in the States are over the age of 58 years old. So it's a sort of baby boomer generation, so to speak, which is getting to that point and thinking about selling. So there's this almost flood of businesses that are coming onto the market now, which present an opportunity for people. And that trend is global. It's not only in the States. I think there's stats which back it up there, and we're seeing the same thing. Which kind of leads us into the next question is how do you think, how do you go about identifying a business that you want to buy? And I think, I'm not going to go into the merits today of using a business broker or not. Okay. I think it's more important to really focus on what kind of business you might want to acquire. Okay. So only once you've really thought about what kind of business you want and you've done your research, only then should you think about how do you make that approach. And again, I'm going to use a house analogy because I think it's simple to understand. When I was 20 years ago, when my wife and I bought our first, let's call it house, we were we married for a few years. We were thinking of starting a family, and we didn't go through an agent. We were walking through our suburb one day. We stayed in a little duplex townhouse, and we saw a family home which we liked from the outside. And we went and we said, like, that's the kind of home we want to raise our family in. And we put a letter in the post box, thinking nothing of it, a handwritten note saying, hey, we're looking. And 4 weeks later, we got this very sort of like cagey call from the owner, like sussing us out whether we were an estate agent or whether we were genuine. It turns out that they were in their early 60s. They were looking to retire to Hartbeespoort Dam, which is just outside Johannesburg. And they wanted to sell the home to a young family. And they wanted a young family to raise family memories in that home. Short answer is we ended up picking a house that we couldn't afford at a great price for us. They were happy, not realizing what I guess the true market value was, because for them, their motivation as a seller was to make sure that their family memories could go into the next generation. Okay, now that sounds like a romantic story, but that's real. And I think we were clear what we wanted as a buyer in that home. To contrast that, we moved cities a few years ago where we came down from Johannesburg to Cape Town, and we looked at 47 homes through agents, okay, trying to find a place that fitted us. So we knew what we wanted. It wasn't a case of going to an agent and saying, what have you got on stock? Sell us the business. And it's like that with the business. If you know and you're clear what you want, so you got to think about what are your interests and your skill sets. So if you a actuary running a pharmacy business, is that the right thing to do? Okay. Do you want a lifestyle business? So are you content to be working in that business and you are the business? And many people, that's great. Running a surf shop or a dive shop in an exotic island might sound glamorous, but if you're somebody who actually wants to build a business that you can sell in 5 years' time, and that's your retirement plan, that might not be the best way of identifying the business. So what's really important is you understand where do your interests and skill sets lie. What kind of lifestyle do you want from that business? It's important to understand, talk to business owners who are running the kinds of businesses that you're thinking of. How does that stack up against what you're trying to achieve and your ideal lifestyle? And I think what's really important here is don't let the tail wag the dog. Just because a business is for sale doesn't mean that you should buy it or consider it. So, thinking about what business you want to buy, you also need to think about things like the industry and the sector that it's in. So are you buying into a growing industry or a growing sector? Or are you the guy that's buying a horse and carriage business like 2 years after the motor vehicle was invented? Okay, so you need to think through all those factors. And I think that process is critical. Once you've done that, once you've found the type of business, a few targets, then you think about how do you approach that? So do you pick up the phone and call the business owner directly? Do you go through a reputable broker? And I think that's important. If you're going to go through a broker, make sure that it's somebody who is reputable, who's an independent advisor rather than somebody who's just trying to flog a business. And I think having that trusted advisor is really, really important. So, Ghost, I don't know if you want to just, maybe share some thoughts on that before I hand over to you in the next section. And that's kind of once you've identified the business, once you've made that approach, how do you go about valuing it? So, Ghost, maybe a few comments just on identifying the target business, and then you can move into the next section.
Yeah, thanks so much, Graham. I mean, I think the really important point there is the tail wagging the dog. Like, don't just buy a business because it's for sale. You wouldn't do that with anything else. So don't do it with something that's going to potentially take up a huge amount of time in your life. You've really got to think very hard about push and pull factors. And I think that came out in a lot of the earlier conversation. Just because you've inherited money doesn't mean you need to spend it buying a business. Just because you got the bonus of your dreams in a corporate doesn't mean you should now immediately go out and invest the whole thing in getting out. And, I do have a slightly balanced view on this stuff. I mean, the first business I was involved in, I lost, at the time, a considerable amount of money for me. Adulting has taught me that it wasn't a lot of money actually. But, it was a lot at the time, and it was very much predicated around reading, Richard Branson's Screw It, Let's Do It. Just try. Nothing can go wrong. Nothing ventured, nothing gained. Let me tell you for free, something ventured into the wrong thing is a disaster. So just balance the whole Richard Branson, who got insanely lucky basically all the way through, against, people who have actually lost everything. And if you can understand why he was successful and why people lost everything, then you're starting to think like someone who should be buying a business and actually, making a smart decision. And then you'll find when you are sourcing a business, that thinking will come into it. Graham, can I dive into the valuation piece?
Over to you, Ghost.
So there's a question in here actually from John around, would be interested in our views around staying in our lane versus taking on something unfamiliar in terms of personal experience. And that talks to valuation as well. And the point here is, if you're investing in something you understand, you are way more likely to smell out bluntly the BS when you read the forecast and you have a look at the unit economics, and the seller of the business promises you, I know my profits went nowhere for 5 years, but next year is my year. Look at this hockey stick chart. I promise my profits are going to triple, and with no effort, I've done all the hard work. And by the way, that's why I desperately want to sell. Just think, like, why is this person selling just before this windfall of money, right? Because firstly, they would get that money within the next 12 months. And secondly, they would then be able to prove that in a valuation going forward. So be very wary of anything that looks like a hockey stick. Yes, they do sometimes happen. They often don't. And I'll talk about, structuring the deal and stuff just now. But when it comes to valuation, when you deal with a lot of institutional level investors who are doing this for a living, they are not an emotional buyer. Then what you learn from them is that you make most of your money, most of your return on your way into the deal rather than on your way out of it. And all that means is don't overpay on day one. It is so incredibly important. It's very easy to get hot for a deal, to get emotional about it. You've spent a lot of time and energy identifying what you want to do. You've always wanted that coffee shop by the ocean. This one is for sale. And then what you end up doing is your bias is that you want to like the business and you want to buy it. So you end up just papering over the cracks and you just say, no, don't worry about that. That'll be okay. I'll fix that. That's not a problem. Just don't do that as much as you can. You've got to make sure that when you're valuing the business, and obviously that's what we're here for, is to be that kind of objective view in the process. It's very, very important not to overpay. You don't want to lowball either, but don't overpay. And I think the point here is you want to think like a strategic buyer, but you want to behave like a financial buyer. So a strategic buyer would not necessarily be an emotional buyer. That's something different. It just means that the target company is strategic for whatever reason. So either it's, a piece of technology that a larger buyer is looking to get hold of, or, it just makes sense because it opens up distribution into a new city and all of the back end, distribution centers are all there. You just need new outlets and you can make way more money than the seller of the business would have been able to. The key principle here is don't pay for the magic that you are bringing. If you are the one who is smart enough to spot that this business has great opportunity and you know exactly how to fix it or to grow it 3 times, why are you paying for the privilege? Then you're working for free. You're basically giving the seller who didn't do those things an incredible exit. So, this is not the time, this is not dishing out sweets at the school to all the kids and being extra nice. There's always a time and a place for that in this world. And no one is suggesting don't be ethical and don't be nice in a transaction. But just understand that every cent you overpay is a cent that you've given to the seller and that is going to hurt you down the line. And that's what makes these valuations so interesting and why it's so important to take emotion out of it. And most of all, to be very skeptical of hockey sticks and huge promises and, the magic that you're going to bring to the transaction.
Ghost, if I may jump in there as well, I think there's a point here that if you're paying, if it's a quality business, it's also important not to completely lowball. So there's a balance over here. If you're buying something which is quality, there's going to be a premium to it. Not every single business is a lowball offer. And I think it's about understanding that, because a key part of this process is actually building trust between the buyer and the seller. If somebody comes to buy your immaculately maintained classic car, we've used that analogy before, okay, which is in concourse condition, and they offer you what they'd pay for an equivalent scrapped version of that vehicle, okay, that immediately doesn't buy trust. Equally, you're not going to pay the same for that classic car as you would for a modern Lamborghini, for argument's sake. But I think it's about that middle ground and being fair to both buyer and seller. And I think the other point you touch on is there's a value of the business to the owner as it stands, and there's the value that you potentially bring. And often a buyer will look at that. You'll say, well, look, what is this business worth as it is? And what is it worth to me if I implement my plans? Okay. And usually for the buyer, if what it's worth to you when you implement those plans is more than what, let's call it, fair value is, it makes a good deal, right? So yeah, I mean, those are just 2 points I wanted to add there.
Yeah, and Graham, maybe just to jump in on that, people get insulted because they don't have the facts. Mm-hmm. So the owner of the business feels insulted by the offer, and maybe it is an insulting offer, in which case you should feel insulted and you should tell that potential buyer to get lost. But you don't know that unless you actually have an objective view on the valuation. And likewise, as the buyer, mm-hmm. you don't know what you don't know. Like, are you lowballing? Are you actually paying potentially too much? And sometimes a seller of a business is just not ready to sell. And that's when you need to be very, very nervous as the buyer, because there's a lot of emotion priced in. Don't pay an emotion premium. If the seller is still very attached to the business and demands 40% more than what this thing could ever be worth, it's time to walk away. Because there will come a day when that seller realizes, oh, hang on, this isn't working. I'm seeing it right now in South Africa in the buy-to-let market, because for 3 years I was very unpopular online because I told everyone that buy-to-let is a horrible idea. Literally today, there is a MoneyWeb article about how half of buy-to-let owners in South Africa want to sell their properties. Well, here we are. The rubber has now hit the road. They had a chance to sell 2 years ago. No one listened. Now it's a buyer's market, and it's going to get worse. And that's how it works. That's how cycles work. And that's why you need to take emotion out of buying and selling businesses as much as you can. It's very difficult, but it's the only way to do it.
Guys, should we move on to the
I'd like to.
Sorry, Howard. Yeah.
Yeah, no, if I could just add to that, I listen with intrigue because I've been through these processes, I think, 15 or 20 times in my life. And that's why we're so passionate about our BizVal tool, because it allows you to get a benchmark and a guide, a North Star in terms of the value when you go in. And I'll tell you why that's important, because if you understand that, the emotional aspects that the Ghost talks about will dissipate. And anything that a seller tells you about, so Ghost refers to hockey sticks, that's the graph that is going off into the stratosphere in terms of the growth in revenue. If they're that excited about it, are they prepared to warrant it? Because if you're prepared to warrant it, you know it's going to happen. And if you are prepared to warrant it and it doesn't happen, then it's going to unlock. So it'll release the buyer from the obligations of purchase or give them some options depending on how you construct that agreement. Warrants are very important. I've done 2 deals in my life that I got punished on, because when I asked people to warrant certain aspects, they said, why do you need to warrant it? You trust us. And these were big listed companies. I'm not talking about a small operator. These were listed, JC listed organizations that said, you don't have to worry about that, we're going to deliver it anyway. And guess what? They didn't. So warrants are critical. If someone's telling you something about the business, they need to be prepared to guarantee it in some form or fashion. And you need to make sure that you're absolutely covered on that. The point Ghost made about buying the business, the profit is in the buying. That's not about screwing the seller to the point that you are unreasonable, but it's about limiting the risks that you face in the acquisition of the business and making sure that they're covered. Because I can tell you, if you're an opportunistic buyer and you think it's smart to go and lowball a good business owner, you're going to land up coming short. It's fatal to the transaction. I've just been involved in one this week where someone came in with a lowball aggressive offer that had no substance to it, and the seller just said, I'll never deal with him. Tell him I'm never going to deal with him. He must go away. I don't want to be associated with people like that. So these are things you have to think about when you're doing it. Thanks, Graham.
Maybe Howard, just to add to that, and I know we always like to share some of the data we've got in the system and what we see in the market and everything else, but something that I think, Graham, we've seen a lot of is the kind of rule of thumb risk when it comes to valuations. This type of business sells on a revenue multiple of 3. Okay, why? No, I don't know. That's what it sells for. Okay, well, has anyone actually done the maths to say what is your return then if you pay 3? No one's done that. Okay, well, let's do the maths. Guess what? If you pay 3, sometimes it's a great deal. I mean, it really does depend. Like, we've seen every version of this you can imagine. You go and kind of have a look at a particular sector. I mean, recently we looked at services businesses in the UK, I think, Graham, and a lot of what surprised us was it felt, correct me if I'm wrong, but I think from what I remember, it felt like basically some of those businesses are almost being given away, which is a real problem. And it's just a lack of information in the market. So, it's it really does come down to just being careful of those rules of thumb. Are they actually proven, or are they just, something that's accepted, but not with good reason?
100%. I think, guys, if we can move on, so understanding fair value and valuation is key. And as you say, that's a range, and getting objective, independent advice on that is important. But let's move on to a little bit once you understand value. So value and how you structure the offer and negotiating the deal are two separate things, right? And I think it's important that we don't confuse the two. So I think let's dive in a little bit around how you structure the offer, negotiate the deal. I'm keeping one eye on the time. So we're hoping to kind of wrap up the formal chat within the sort of next 10 to 12 minutes, and then we'll have about 20 minutes left for questions. So guys, if you can spend the next sort of 5 minutes just talking around that, and then Howard can pick up on the last two topic points.
Yeah, absolutely. So, and I really hope everyone can hear me. I see there are some issues with that, but remember the recording is made available afterwards. Okay, so basically on structuring the transaction, what you need to remember is the buyers and the sellers are diametrically opposed, right? So what that means is if you are the buyer of the business, what do you want? You want to pay as little as possible. Okay, fine. We've dealt with the valuation. How do we structure it? Well, I want to delay the payment as far out as I can. I only want to pay you in 4 years' time for this business, not right now. Best of all, I want to pay you based on how the business actually performs. So that's called an earnout. So the first part is a deferred payment. It's just the passage of time. Sometimes when a deferred payment has conditions attached to it related to profit or revenue or anything, then it's an earnout. So in a perfect world, as the buyer, and there are a lot of buyers who try and structure this, they want to come in, pay you a PE earnings multiple of like 3 and pay you over 3 years. So what are they doing is they are basically paying you with your own business. They are taking the profits of your business and they are paying you with them. And you are taking the credit risk as the seller, basically on whether or not the buyer is going to be able to do that. And that's where it's very important, not just to have some common sense in transactions as the seller, but, have basics like, security over the shares. I mean, we can get into all of that later. But I suppose the point here is from a structuring perspective, you've got to be careful of what sort of behavior is being incentivized across the board. So, for example, if the earnout is you're only going to punish the seller if the business doesn't do as well as you think, but there's no upside for the seller if the business does better. You're not really incentivizing the seller to hand over the best possible business, right? So you need to be careful of making sure there's an incentive as well as potentially a punishment. And at the end of the day, you can't structure any of this stuff, any of these profit warranties, any of these revenue warranties. You can't do anything unless you've actually gone and done a proper forecast on the business. You need to really dig down to what is actually going on. Ignore that beautiful slide with that lovely chart. You need to go in and properly understand it. And then you can negotiate the earnouts, properly as well. And it also helps to be able to actually model that out. And I know that gets quite technical, but this is why when you're buying a business, especially one of size, you really do need to think about getting professional help, because you need to be able to go in and say, okay, if the earnouts get hit, what will my return be? Am I then going from a scenario where it looks like this was a good trade on the way in, but actually the earnouts are so lucrative and actually too easy for the seller that I end up with a scenario where I'm then actually losing out. I go from a great deal to potentially a very bad transaction. So I guess the point today is, there are many, many ways to structure deals, defer the payments, make them conditional, all that kind of thing. Sometimes it can be a minority stake initially, and then a pathway to control is what it's called. You can have call options where you buy out more of the shares down the line. Basically, human creativity plus finance equals deal structuring. And we both know how creative people are. So there are many elements to it. And I think the lesson is it's well worth, speaking to people who have done this a lot and understanding what your options are.
Yeah, Ghost and Howard, maybe if you can comment. I see there's also a comment here from BJ around just, can you talk a bit more about the warranties and what could some of those warranties be and look like? I think it's linked to that point. And maybe just also linked to that, I think the point you make, Ghost, is that you see a lot of these things on LinkedIn and all that, like buy a business without putting any capital down, just pay the owner from their profits, So again, with a lot of these things, it's about balance and incentivization, right? So maybe we can just touch on a couple of those. So talk a little bit about the warranties and the structuring of a deal. And then also the sort of notion of, get a business for free and fund it out of future profits. I mean, I think those are two things to maybe dive a little bit into.
Do you want to do the warranties, Howard?
Yeah, I'll do the warranty side for you. So the warranties are very interesting because it depends what you want to warrant, because warrant at the end of the day takes away the risk or mitigates risk. You can never take the risk away completely, because whoever takes risk gets reward, and you want reward. So you're going to take some risk. But warranties, you can structure any way you want to. And I want to actually take a step back before you even get to the warranties, specifically to the person who asked the question. You need to due diligence. You need to go and have a little bit of an interrogation into the things that they say are there. So a cash flow due diligence is a very important one. Don't overlook it. Go and have a look at how the cash is derived, how much cash is held, how much cash is available at the end of each month. A good old cash book, that's what it is. And look at those aspects of it, because from the due diligence that you do in the different aspects of the business, it might be contracts, so you might have to due diligence the contracts. It depends whether it's a services-oriented business or a goods sold and delivered or a products-based business. Those things are important. But ultimately, it'll be the revenue, and revenue is derived from sales. Sales sit in the sales funnel. So you need to go back and look historically how the sales convert. So from where there's interest to where they actually arrive in the income statement is critical. And then you want to look at those aspects and get warranties around that. So those are the critical parts to warrant. There are so many things that you have to warrant, and that's where getting a good legal team is really important. Having somebody that understands the risks in the particular business that you're looking at, because they're all different. A gold mine is different to a fish and chip shop, and a property portfolio is different to anything else. So you need to be aware everything presents its own risks, and it's the warranties. If I think as a broad principle, all you remember is that warranties mitigate risk. So the risk aspects of the business need to be warranted, and that might come to the point that Ghost raises in terms of how you pay for it, because then you can start stretching payments. You might put down a deposit and stretch the payments over a period of time to prove to you that the things that are warranted are actually there, and the things that you paid for are going to give you a return. And there's nothing wrong with that in a small business, or any business for that matter. And that's why these things are so carefully structured. Very difficult question to give you a lot of detail on, but I think we've given you enough just to think about it.
Yeah, Graham, I think you had a question to me around deferring payments and just a little bit about that. I mean, look, I think you have to recognize that the best businesses probably have some of the best managers, and the best managers and founders tend to educate themselves about this stuff before they run off and sell a business. So, at findersucker.com, you may well find a whole lot of businesses who are happy to sell and get paid out of their own profits with all the credit risk over 3 years. And, good luck to you. You'll basically be buying a business that was built by someone like that. And I don't mean that in a disparaging way, but just understand you are buying the child effectively of that founder. If you feel like this founder has no idea what he or she is doing when discussing a deal with you, you've got to ask yourself some pretty serious questions about the underlying business and what has actually been built there. And do they have a handle on the numbers? What do they know that you don't know? Who is the sucker? It's not always who you think it is. So unfortunately, this is life in private companies. This is why it's very different to investing in a listed company where you hope that what has been put forward to you is real. Still not always the case, but often it is. Private companies, not necessarily the case. It can be very, very tricky. Graham, there's a question here there's two questions about valuations. Do you want me to do them now quickly as part of the section, or right?
Jump into them now. I see a lot of questions are coming through. So, I think it's appropriate to deal it now. And okay, cool. Let's dive into those, and then we can move on and give Howard the floor after that.
Yeah, perfect. So there's one here that's music to our ears, which is, where can one access guidelines on PE multiples for specific types of industries and businesses? Well, I have a great example for you of where you can get this from because this is our business. But on a serious note, obviously the way we do it, is a combination of industry experience, deal experience, looking at listed companies in certain sectors. The reality is that a really high-end tech company with recurring revenue and great margins is definitely going to trade on a higher multiple, than a factory in the wrong part of Gauteng that kind of has broken windows, but it spits out cash. These are just the realities of life. Obviously, a lot of the valuation work we do is on the specifics of the business and what we think the required rate of return should be. So in many cases with what we are doing, the multiple is the byproduct, not the key input into the valuation. And that is very, very important to understand. That is really how markets work if you really dig into them. It's what returns are people happy with, and hence what are they willing to pay. Unfortunately, a lot of people think, oh, but I must only pay 6 times earnings. That's the maximum I must pay no matter what, or no matter how bad it is, I must pay 6. Unfortunately, that's very, very inexperienced level of thinking with valuations. That's not how they work. The multiple is actually the output. And then there's a question here around, how do you value a business that was generating losses for 4 years, and then on the 5th year, it makes a profit? I think the answer to that would be where you are in that 5-year journey. So if you're sitting in today and, the forecast says I'm going to lose money for the next 4 years and make money year 5, that's very, very different to saying, okay, I've made losses for the past 4. Here's an extremely good reason why I will make money next year, and I just need capital because of X and Y, whatever the case may be. Evaluation is always about taking the cash flows from the business at a point in time and expressing them in today's money. That is a valuation. So if those cash flows are 5 years out in future and they are very risky and it's not clear that they are going to happen, you will discount them at a much higher rate to today, and the business might be worth something, but it's not going to be worth a lot. As you bring that date closer of achieving profits and having positive cash flows and de-risking the business, you just see that valuation expand. The discount rate comes down, the cash flows are nearer to today, and suddenly the valuation jumps. And if you watched any listed stocks over the pandemic, that's exactly what happened. Interest rates went down to basically 0. These businesses promised unbelievable cash flows 10 years in the future. And because the time value of money was basically null, people were like, okay, cool, that's not a problem. I don't mind if they only make a profit in 20, whatever. I'm happy to pay a big valuation today. Yeah. Most of those stocks are now 50, 60% down because the cost of money has gone up. So this is why I say valuations, the multiples and stuff is really the output. Yeah. A lot of what drives that multiple is the understanding of when the cash flows are happening and what discount rate they should be discounted at.
100%. Ghost, I think I'm just keeping an eye on the time. Can we maybe just deal very quickly around due diligence? I think that is important. And then, Howard, I want you to talk a little bit about the securing of finance and the post-merger integration. So we can at least leave another 10 minutes on the end just to handle some of the questions we haven't gotten to. So Ghost, maybe within 30 seconds you can talk a bit about due diligence. That's a topic all on its own, but I think there are some points worth making.
Yeah, definitely.
And then over to you, Howard.
For sure. So basically a due diligence is really just making sure that this person is what they said they are when it comes to the business. If you think about this in terms of dating, you go on the first date, you like the person. Now it's DD time for the next year or 2 years or 3 years until you potentially commit, for life. That's what the DD is, except unfortunately you don't have 3 years. You have, a week or 2 weeks. So you need to go in and you need to say to yourself, what is the most important thing about this business that I need to be true in order for me to invest? Now, obviously the revenue is the first part and the biggest part and the most important part. You got to understand, is the revenue real? Are these real customers? Can you see the track record of delivery? Are they happy? What does the sales funnel look like? And then cash flow. Do those sales land in the bank account? Otherwise, they are nonsense. They don't help you. So you need to see the bank accounts. You need to see the money coming in. You need to see the real cash expenses. What are those normalized expenses? Those are the absolute basics. And then what you probably need is a tax expert to just have a look for you at this business's tax affairs with SARS. And there's a lot of the approach taken in many transactions is it's very hard to know for sure that there are no outstanding legal claims, that there are no huge skeletons in the closet from a tax perspective. So what you'll often do is get the seller to actually warrant that stuff to you. And then you actually will go back and try and claim back from the seller if something does come up. Okay. Obviously, you never want to get into a court fight. That's not where you want to be. So DD as much as you can up front, and then use warranties to basically plug the gaps.
And I think there's some very practical points. I think it was a comment from John, which are in the comments around actually kicking the tires. Look at the Google reviews, chat to some of the customers of the client. As you say, what do the offices look like? are they a mess? What cars are management driving? All those sort of subtle things are really important markers, and that sometimes get neglected. So John, thanks for those comments. And, I think those are really practical tips, particularly in smaller businesses. So Howard, over to you just to talk a little bit about sort of securing finance. And this also talks to earnouts and kind of how you raise money to buy a business. And then also the first 100 days. So if you can just spend 5 minutes talking through some of your experience there, and then we'll deal with any other questions from the floor.
Okay, I think if you're going out to buy a business, first of all the points that were made before this really apply are very what you're doing, because that'll affect how you fund it. There are commercial funders out there who are prepared to do it. They're going to expect you to put some skin in the game. No one's going to give you 100% of the purchase price and believe in you. That's not going to happen. There's other ways in terms of getting angel funders, other venture capitalists involved. But you've got to understand that whatever you do that involves outsiders, you're going to be diluting your interest. So I think that's a fundamental principle. Unless you've got a really rich uncle, which I think we all wish we had, but don't, who's prepared to throw the money at the opportunity and see if you succeeded. That doesn't happen in real terms very often. And often if it does happen, the businesses don't do very well. So you want to, when you're thinking of funding, think very carefully how you're going to fund it. You want to do it as economically as possible. You don't want to throw unnecessary financial money resources at it, because those tend to generally not do too well. So we find in our data businesses that have been bootstrapped, that have started with an idea and the person's funded it themselves, and they've grown the business out of the profits, or they've grown the business out of the revenue. Those ones tend to succeed far more than something that's been funded. Once you're up and running and you need more funds, you might need to grow. There's things called mezzanine funders. Just to understand, a mezzanine funder doesn't do anything at prime minus anything. It's prime plus plenty, and they make money out of lending money. So they will lend you the money to help you grow your business. You have to be absolutely certain about your growth trajectory, be very confident in your ability to deliver it, and make sure, because often they have ratchet agreements attached to it. And what that means is if you can't pay the money back, they take the equity in the business, they take shares off you as compensation. So funding, it is such a wide topic. In fact, this whole webinar today has such a wide reach of topics. We could literally sit here and talk for the next 3 or 4 days about all of them and not get through it. And I think for the team here, we start to understand some of the subject matter we need to expand on in the future, although we touched very lightly on everything today. So if there's anything you want us to amplify or to look at future webinars, please let us know. We'd love to share some in-depth experiences.
Yeah.
The hardest part after a merger or an acquisition is the 100 days afterwards.
Howard, if I may just jump in quickly just on the funding piece, and I think just to touch on 2 things is, which you didn't cover, is just maybe things like share swaps. Sometimes there's this notion of buying a business and doing a share swap. That's something you need to be very careful of it. And most sellers will want a fairly significant chunk of cash on the table, right? Yes, you can sometimes buy businesses and just pay for it from profit. So I think I just want to touch on, as a buyer, like often we hear but the seller wants a warranty. If it's a legitimate buyer, you do need to be prepared, I think, as a buyer to present proof of funds. Whether that's your bank prepared to underwrite an extension in your mortgage, or it's a pension payout that you're going to use to acquire the business. Those are normal. And it's really an indication that you as a buyer are serious. Yes, you do get exotic deals where cash doesn't change hands till later. But I think that is important to think about that. And maybe just one other point to touch on here. In South Africa, it's not as prevalent, but in certain jurisdictions, like in the United States, and depending where you are in the world, often there are government or bank-based schemes to assist in raising business funding. So in the US, there's the SBA scheme, for instance, where you can get deal support for acquiring a business, etc. So, look at your local business areas. Look at those sort of development programs. Sometimes there are opportunities to unlock funding, but they will all insist in some degree of skin in the game from you as the purchaser or the buyer. Sorry, Howard.
Yeah. So thanks, Graham. So the first 100 days after your merger acquisition, and let's assume it's a partial. So you're selling your business, someone's come in and they bought 49% or 51 or whatever the case might be, or 20%. Then there's the period after that transaction is struck, and I'm talking about all the ones that I've done. I've been on both sides of that fence. But when you're a seller, and you still remain in the business, there is such a thing as buyer's remorse. And I don't care whether it's a listed organization or it's a small company, they all seem to go through it. For some reason, they sign the deal, pay the money, and then go on a witch hunt to see what wasn't there. And it's a very human thing. It's like when you buy a second-hand motor car, you take it home and check it over. You think maybe it's accident damage, maybe it's not what the person said it is, and that's a very normal one. I mean, I was involved in an extreme one in 2008 with the GFC, the global financial crisis. All the markets collapsed. The company had just bought shares in our business, and of course they were witch hunting through the business, and how I nipped it in the bud. I just said to them, I haven't spent a cent. Do you want your money back? Please take your money back and go, because this is hard. And they backed off, and we actually became good partners after that, and everything went well. But it's very normal to have buyer's remorse, very normal for the buyer to be circumspect about the investment they just made. They've sometimes parted with a lot of money, and it hurts. And it's like when the ghost was talking earlier, and I thought about when deals are struck. Often they say the best deal is when both parties are slightly grumpy, because then you've done the right deal. So one person mustn't be vitriolically bitter on the one end, and the other one absolutely elated that they've stolen the asset, because that doesn't look good for the future of the business. But again, it's how your emotional intelligence on how you navigate it. If you put the right warranties in place, the first 100 days is very simple. Because if you live up to the warranties, you live on the warranty, there's nothing to hide and there's nothing to discover, and everyone's happy. So I think in all of these things, if you look at the first 100 days, in the first 100 days, you've done a good deal. If the person you've sold your shares to or sold part of the company to is looking for new opportunities with you to help you leverage the growth of the business, there's a really healthy sign. Who cares about the past? Let's get stuck in. Let's take 1 + 1 and make it equal 10, not 3. And that's the old investment banking saying 1 + 1 = 3, because then you've got a great deal. But I'd say 1 + 1 = 10. You're on fire, and you're looking at each other to use the different capabilities you bring to the opportunity to make it grow. And that's what the future is. The thing grows and it works. Everyone's very happy, and that's what should be the focus. Warranty should save you. The first 100 days would be about unlocking the future value. Thanks.
Thanks, Howard. And I think just to underpin to that is, first 100 days is all about, trust is the underpin of all these deals. In the first 100 days, really validating that trust, which is super important. There's a few questions that have come through, and a couple of comments. I think one was a typo, but I think, as you can see from today, there's a huge amount to cover in terms of acquiring businesses. And I think we've probably just scratched on the surface of it. Each of these topics could probably be a webinar in and of itself. So hopefully we've managed to pique some of that interest, and I'm sure there will be some follow-ups to this on some of these points. But a couple of questions I think I want to just tackle quickly is, I think there was a question coming through, what sort of duration of earnouts do we typically see in South Africa and also outside of South Africa? And there's also a comment from Nathan who raised that question, is the funding gap for smaller businesses with, let's say, an equity value of between, $1 million to $3 million. The private equity firms will come in at bigger than that, but there does seem to be the sort of missing middle. So, Ghost, perhaps you want to just kind of reflect on those two questions.
Yeah, sure. So earnouts, generally, you don't see more than 3 years, to be honest. Regularly less, very rarely more. I think that's the easy answer. On the funding gap, so the problem you've got there is just South Africa is obviously a low growth market, sadly. So what you end up happening is a scenario where private equity firms, institutional level investors have expensive staff. They need to spend their time on a whole variety of opportunities. And it doesn't help you if the maximum you can make on a deal is R1 million over the next year, and you're paying someone R2 million to do the analysis for you. And clearly that doesn't work. So you do have a funding gap. I must be honest, it's something that I hope one day we will help solve in BizVal, is actually connecting more in the way of like high net worth individuals and family offices into, proper SMEs that actually have good growth prospects. So not necessarily big institutions with expensive teams, but sorry, Howard, I'll use the example of you, investing in Bizwell, like a Howard type person who's passionate about business, can understand a gap, has done it many times in his or her life. One day we will get that right. So yeah, I agree with you. The gap is there and it's a problem, and hopefully we can help solve it.
And then the couple of questions, I think they kind of linked. The one was a comment from Garth, is most founders don't seem to, or business owners don't seem to have a handle on their numbers from what they've seen. What are our thoughts here? And then a question from John around smaller businesses seem to highly value their own brand. I think we've covered this before. Is there any way to try and value the brand and future brand? So maybe just deal with the comment around, do we think business owners have a handle on their numbers? And then how do we deal with that brand question again?
Okay,
Yeah, perfect. So, sorry, how do you want to grab it?
Yeah, I just want to talk to you because it made me laugh, because it applied to me at some point in my life. So, yeah, we don't always have the greatest handle on our numbers, but I employed people who did. And the reason why we're so passionate at that point is because we understand the sales cycle and we know how to build a business. We understand our sales funnel and we get really excited about that. And sometimes completely overexcited. You're absolutely right. We'll oversell it. That's what we're there to do. We're there to sell and to build. And you need people like me to do that. And you need your accountant to put the handbrake on and bring you back to reality. So we'll always sell forward. That's how we do it. But you don't buy forward. Or if you do buy forward, you want to buy on a warranty and an earn out, as opposed to just accepting that the forward value is the value. And I think it's a very valid comment. Yes, founders often haven't got deep inside their numbers, but they've got an unbelievable confidence in terms of being able to build a valuable business.
And I think in smaller businesses, if you can prepare a proper set of management accounts and your last financial statements are up to scratch, you'll be amazed what that does for your valuation. Exactly because of the point that most founders don't have a handle on the numbers. So as a seller, what you need to try to do is delight the buyer. The buyer is coming into this expecting that you've probably got a whole lot of slips under your desk, and that's your financial system. And so if you can show them a proper set of numbers and monthly management accounts and your audit's up to date and your tax is clean, you will be amazed at the feeling that can give the potential buyer.
Ghost,
just on the brand, yeah.
Sorry, before you finish that point, I think something is also very important. If you're a buyer and the management team are extremely bullish about their numbers, and you think they're being a little bit over bullish, a very quick way to check that is to ask them what cover do they keep in the business. And when we talk about cover, I know in all the businesses I've always had between 3 and 6 months cover of overhead costs available either in cash or available to be able to keep the business sustained. And that helped us during COVID, for example. And that's a hot knife through butter on the financial sustainability of the business. If the owners have built cover and have money in the savings account to cover the rainy days, they have a long-term view of their business. If they are cash stripping their business and there's just debt, but no readily cash available, and they're dipping into debt at the end of every month to trade, guess what? It's not a good business. So those are just practical things. Sorry, Ghost.
Yeah. Ghost, if I may, I think just in the interest of time, I think those questions that we haven't got to, we'll respond individually to the guys who've raised the questions. So I want to just say thank you to everyone for joining us today. We want to wrap up in the next 30 seconds. As I said earlier, hopefully we've piqued your interest in the topic. It's a big topic. There's a lot to cover over here. And I think what we'll do is dive into some of these sort of subtopics in future businesses. If you've got any questions, if we haven't addressed your questions today, the door's open. Make contact with us. We're on a mission to share and empower both business owners, buyers, sellers, and do that in an independent and transparent way. So, thank you to everyone for joining us today, and to Howard and to Ghost, thanks for sharing your insight and your experience. And we hope you guys enjoyed today. And yeah, remember the webinar is available on YouTube, and please feel free to share it with your friends and colleagues. And Howard, Ghost, any closing thoughts from your side?
Yeah, I just think it's incredible that we're able to share our experience with the audience and give any guidance that we can. And I can't, we started Bizwell because we were so excited about sharing our experience with the market in a scientific way, that we would build data and share that data that empowers people to make really good decisions around their business activities, whether they're buying or selling. And I think we're achieving that. If you look at the reach that we've got, it's incredible. And it just feels good that after having been an entrepreneur for over 42 years, that I'm able to share this back. And, some of it's for free. I mean, it doesn't get better than that. Enjoy it, use it, it's free. Interact with it. It's the best way we could pay back and share what we know with people. And we really enjoy participating in this forum. We're going to continue to build this business globally and give you more and more relevant data as time goes on.
Thanks, Howard.
Graham, my closing comment is I'm responding to those last two questions in the chat because I'm too lazy to email afterwards. That's my closing comment. Just thanks everyone for coming, and I'm answering the last question now.
Thank you, everyone. Have a great day further.